Hello and welcome to the show. It's been a rough week in the markets with the Dow S&P 500 logging the worst day in about 6 weeks as fears over a coming recession grow. The one bright spot that remains is consumer spending, which is still holding up. The question is, can U.S. consumers save the day? I talked to David Parlee. He is Co-Chief Investment Officer for Epoch Investment Partners about what he sees happening in the U.S. economy and where he sees opportunities in the markets. There's a lot of uncertainty out there. I mean, the markets are swinging day to day in all sorts of different directions. But when you look at, Brexit, U.S.-China trade war, impeachment inquiries and all that good stuff, what is your take right now on the strength of the U.S. economy and the likelihood of a recession?
Yeah, no, it's clearly very volatile news-wise, but when you look at the economy, it has continued to remain very, very strong, driven by long-term trends, which are employment growth very, very strong, leading to some wage growth, consumer confidence being very, very high, actually. And when you look at a lot of the consequences, including the trade war, it has had little effect in the United States. Like the tariffs have effectively been eaten by China in that they lowered their currency, which basically absorbed that cost raise to the United States. So up to now, the consumer seems to be pretty happy and confident about their future, which leads to, of course, good profit growth for economically sensitive stocks that deal with consumers. So profit growth remains relatively good. The issue is the market outlook almost changes day to day as to whether we're going to go in recession because of all these issues, trade war, interest rates, issues around the world, or whether the U.S. continues to be good. And the U.S. is a mostly self-contained economy. It's not an export-import driven economy relative to many of the others. So consumers are leading it forward, company earnings have been good, and there are particular opportunities right now in cyclical companies because the cyclical companies have discounted most of the recession fear. In other words, people have gravitated over the last few months to defensive companies that are not economically sensitive. They grow very, very slowly, and now they're at high valuations, whereas the companies that are going to benefit by economic growth are interestingly trading at the low valuations right now. So that's where we've positioned the portfolio, and it has to be a longer term view because on any given day, the market can go up or down quite a bit. Well,
it's interesting to listen to you because you sound so much more optimistic, I think, than we do here. But I want to come back to, and forgive me for a news item here, the inverted yield curve. I mean, we've been hearing about it. Suddenly the world is educated on yield curves when they weren't before. Historically, it's been fairly reliable in terms of predicting a slowdown and recession. Do you think what is it showing this time, or do you watch this one that closely?
Yeah, I think it is a little different this time, and no, I don't think it's that important either, by the way, but the reason it's different this time is the typical economic cycle is that the economy does well and doesn't die of old age. It dies because of two things. It gets overheated, so job growth becomes so good that the market becomes tight, and wage inflation concerns the Federal Reserve, which raises the short rate so much that it goes above the long-term rate. This is not one of those. This is the rest of the world doing poorly to the point where we have negative yields in Europe, that an Italian 20-year, 30-year treasury is trading at a lower interest rate than a U.S. bond. And guess what people in Europe are going to buy? They're going to go into the U.S. So long rates have calmed down and gone below the short rates. So it's actually been an issue of weakness in the rest of the world rather than an overheated U.S. economy. The U.S. economy is growing at a moderate pace. Inflation is benign. And when you think about the Fed, their task is to keep economic growth and inflation at a moderate balance. So they are okay with where it is. It has some effect on lending, yes, but really, as far as an economic indicator, it would only be because of what caused the rate to rise, being inflation or a poor economy. The other issue would be is if job growth really slows.
So it's the mechanics of what actually gets it there, which is the important part. Let me ask you, you brought a chart in, and I guess to your belief in terms of what's happening with the U.S. economy right now. This is, we'll bring it up, the Bloomberg Economic Surprise Index. What is this showing?
So it's showing that there's a bunch of economic indicators, both consumer, like basically consumer spending, housing, things that consumers buy, and then manufacturing and corporate corporate spending. And I think most people would think that these are all going negative. They've actually turned more and more positive over the last few months, particularly the consumer. And it's because job growth remains really healthy, and we're beginning to see some wage growth. So that's what is surprising, and it's beating the consensus view. So it's not that the economy has jumped up, it's just that consensus was moderating and the economy continues at a pretty decent pace. That's the surprise. And so when you look at all this, you would want to be positioned where that spending is, because that's what's going to drive revenue and profits. So it's more consumer-centric, but corporations are willing to spend as long as they have a good view of the world economy. I think the major thing hurting manufacturing and business spending is trade. So then we get to the issue of, will we have a trade conclusion with China?
Will we?
I think we will. Now this, no one really knows, of course, but we look at it and go, both sides have much to gain and a lot to lose. The question is timing. Because, President Trump would like to get reelected. It probably would be better to get this done and get a deal done before the election. The Chinese are hurting more than the U.S. is. You can see it economically. Their GDP growth has really decelerated because of the trade war, but they can hold out a lot longer. They're not worried about an election. So the question is, what will be the catalyst for both sides to compromise so it's a win-win, and it has to be a win-win. But we think it will happen, and frankly, if you believe we'll never have a trade conclusion and we're going to have high tariffs, you would want to really run for the hills, have very defensive stocks, be cash holding, because it would be terrible for the U.S. economy, and it would be bad for the entire world economy. For instance, the Germans have really been hurt by our trade war, because one of the bigger exports to China are Mercedes and BMWs that are made in the U.S. that go to China.
But that is not your belief right now, that you do think that there will
be a conclusion. I think as a whole, the market is fairly valued, but I think the good news is, as a stock picker, there are definitely valuation discrepancies. And I do think the valuation discrepancies are, there's value in cyclicals. Companies that are economically sensitive normally trade at a high valuation on their low trough earnings in the cycle. Right now, those companies are trading at low valuations on their lowest earnings. Areas like semiconductors, housing stocks, and financials. Now, Bank of America has had 6 quarters of record earnings, quarter after quarter, and has actually had double-digit return of capital and earnings. So the stock should be up a lot, but the multiple, the valuation, keeps compressing. So in other words, the market is discounting this, saying it won't continue. We think it will continue, given our economic outlook.
Let me ask you, for financials, again, it sounds like that's one name you like. I think you like some other names in the sector. But the other thing, I guess, with financials is that you've got a Fed that is cutting, despite the fundamentals we just talked about. And you've also got some very real politics that have to be managed in terms of, incoming, perhaps presidential candidates on the Democrat side who have experience working with financials and are not seen as, Elizabeth Warren would be somebody who would be an issue. I think people would watch carefully.
Right. So there is almost a polar choice if it was Elizabeth Warren versus the current president.
And we should give background for people who don't know. She has a lot of experience working with financials in a consumer advocate position in a previous life.
Right. She is almost the personification of government regulation. And if you really look at the expansion since the election of President Trump in the U.S., the expansion of the economy has had more to do with regulatory relaxation than even tax cuts. It's really letting companies feel better about investing money, less worried about regulatory issues. Banks were not even lending much in the last few years of the Obama administration because there were so many rules and so many penalties attached to it. So really, you're going to have a very stark choice about more government regulation or less government regulation. And this extends not just to the financials, but to energy. Elizabeth Warren would end fracking in the United States. She would be very anti-fossil fuel. Healthcare would be nationalized, which is quite a step in the United States, where 140 million people have company healthcare that generally they're happy with and would have no choice but to go on the government. So it would be a radical change. So it will be a stark election if that was the case.
And let me just then, so that aside, I'll say, because that's a significant material event you'd have to watch. With that aside, though, financials is an area that you like.
Yes, because the current environment is still good for financials. This misnomer is that when yield spreads flatten, banks can't make money. Most corporate loans today are variable. It's LIBOR +2. So yeah, LIBOR goes down, but they still have a spread of +2 on the loan. So much less is dependent on matching short-term and long-term loan duration. So it is much more about fee business and the volume of business. So if the economy is healthy and more loans are being made, banks make a lot of money. And most of the larger banks are also in the securities business. B of A owns Merrill Lynch, JP Morgan, of course, is a securities firm as well. It goes through almost all of them. So they are pretty diversified, but generally tied to the economy.
David, thanks very much.